Hello, and welcome to the Laddercast, where we teach you how to leverage your assets to change your life. I'm Sorsha Porter, and in 2016, I bought my first home, which completely changed the trajectory of my life. I turned that property into a business, a trip around the world, a new career, and quadrupled my household income. And now I'm a real estate agent licensed in Oregon and Washington.
And I'm Shannon McAllister. After finishing college with a degree in finance, I was in a job I hated but couldn't quit because I wasn't making enough money. I signed up for a class to learn about mortgages taught by a real estate investor. 17 years later, I'm a nationally licensed mortgage lender, homeowner, and investor myself. We aim to educate how getting on the property ladder by owning just one home can change lives. It changed ours.
Hello and welcome back. It has been a minute.
It has. I'm glad to be back.
I'm glad to be back too. We're going to jump right into it today. Today we're going to talk about DSCR loans.
Woo.
Mostly I'm going to ask Shannon questions and she's going to talk about it.
Okay, I'm ready.
So, Shan, what does DSCR stand for?
DSCR, Debt Service Coverage Ratio.
And what does that mean?
Ooh, spicy, Sorsha.
Spicy. What does it mean?
In relationship to mortgage loans, debt service coverage ratio is a tool to analyze the cash flow of a property. You are looking at the debt coverage with rent, and you are being qualified to purchase that property based on that.
Okay, so basically, if you buy a duplex and the rents cover or exceed the mortgage,
you can buy that duplex.
And does this mean that they don't need to provide any other supporting documents other than proof of down payment?
That's correct. Your personal income is not a factor into your ability to purchase this property because according to that debt service coverage ratio, this property cash flows with the loan that you're trying to get, and that's enough to make it happen.
Okay, and that's with that. And when we talk about what the loan is, we're talking about PITI, correct?
Yes, all in. The whole mortgage payment, principal, interest, taxes, and insurance. As long as your rent is equal to or exceeds that, you can qualify for the purchase of a 1 to 4 unit investment property without your personal income being factored into the equation.
That's pretty cool. So it also sounds like it's pretty specific. So who is this loan ideal for? Like if you're listening to this and like, what does your profile look like?
Your profile is likely someone who owns rental properties already and has a hard time documenting personal cash flow. Maybe you are trying to make a go of living life on your rental income and your interest in dividends, and you're not quite there yet monthly income wise to show good solid income enough to qualify for a mortgage loan.
But you want to keep making investments to keep growing that. Okay.
Yeah. Here's an example of someone last week I spoke with about when we were thinking through these things. This person owns something like 6 or 7 rental properties right now, and historically has used his self-employed income to help qualify. He was a contractor.
Okay.
And so we used his business's income as his personal income to help qualify for all these things, in addition to the cash flow on his properties. The whole combination of all of these things gave him sufficient income to qualify to purchase properties. The last couple of years, he's been winding down his construction business.
Okay. So he's like not got as much income anymore.
Correct. His personal income has gone down. So now he no longer really qualifies to purchase properties with conventional mortgage financing.
Gotcha.
And so we looked into these DSCR loans as an alternative because, again, it's based on the cash flow of the property. Now, here was the trick with him. We were looking at this in relation to purchasing new investment properties, 2 to 4 units, likely a couple of them, with the proceeds of a 1031 exchange. So he was selling an investment property that he already owns, taking the proceeds and reinvesting them into new properties. But he couldn't qualify for the new properties, even though he's selling one that he could qualify for. He has one, and he's been making payments, so he could qualify for it before. But now when he sells that and he takes those proceeds and wants to reinvest them, he couldn't get a mortgage.
Because he just didn't have quite enough income.
His income profile had changed.
That makes sense. Okay, so this isn't really a product for like a new investor. This is a product for someone who's more seasoned and has a more complicated financial profile.
I'd prefer if that was the case. I'd prefer if this wasn't your first. I mean, you could do it. Don't get me wrong.
Like you could, but it's not necessarily the best way to get into your first investment property.
We're just going to have a real good, long, and hard discussion about these things. And if it's the right thing to do, that's cool. But please don't go do this and take advantage of all of the other options that could come along with them that a savvy investor might consider. Don't go get this on an interest-only 40-year amortization. Please don't do that on your first rental property. Let's talk through that more thoroughly.
Okay. Now, let's talk about the requirements for it. What is the down payment requirement? Because previously we've talked about a lot of low down payment loans, but this is really an investor loan.
It is an investor loan. You cannot do it on a primary residence because you don't rent your primary residence technically, right? Even if you are going to. Can't put that on paper really.
Yeah.
In a way that makes you be able to purchase them this way. It's for an investor. Your minimum down payment is going to be at least 20%. If you're doing 2 to 4 units, you're going to be more than that.
Got it. And then the credit score, what are the credit scores stringent? Like, I mean, if you're not providing any income proof for this, if it's just the property that's qualifying, then do you have to have really good credit?
Not really.
No,
I've seen investors who will do them in the mid 600s.
Dang.
Yeah. For an investment property, not terrible. Now, you're probably going to pay for it. There are risk factors associated with those things. And so if your credit score is on the lower end of the scale, you're going to pay more in interest or discount points for the privilege of getting a loan like this versus somebody who might have a little more excellent credit. They might get a slightly better rate than you. That's okay.
So for this loan, it sounds like it's really specific and like it's a fairly narrow field of interested parties who would do it. What are the benefits? Why is this attractive to an investor?
For the exact reason of the example that I just gave you with the dude whose income profile changed. He's going to 1031 a property, meaning he is selling an investment property, and he must reinvest the proceeds of that sale, which was somewhere in the neighborhood of $400,000.
Into something new.
Into new real estate, or he's going to pay capital gains. And the estimate on that capital gains was something like $190,000. So no bueno. You must reinvest proceeds is the word I'm looking for, into new real estate. And so what are we going to do if you don't qualify conventionally? That's the ideal person. Or a person who, in my opinion, the ideal person is somebody who can't show income conventionally. Because you want, if you can, you should. Yeah. Now here's the trick. Here's why. Let me tell you though.
Yeah, that's what I'm getting at. I want to know why it's better.
Why you would, if this one is so easy, if it qualifies and it works, and it's much easier than going the conventional route where we have to analyze tax returns. Here's the why. Conventional mortgages, Fannie Mae, Freddie Mac, limit you to 10 investment properties at this time.
So if you're moving at a good clip on your properties, you could be stuck.
Yep. So you don't want to waste one of your first 10 if you don't have to with the DSCR. Ideally,
you wait until you get to
11.
To the 11th one.
Yes. So Fannie Mae, Freddie Mac, if you have 10 investment properties financed, any kind of financing, it doesn't matter whether that was conventional, alternative, portfolio lending. If you have 10 investment properties that have loans on them, Fannie Mae or Freddie Mac conventional mortgages will not allow you to purchase an 11th investment property with their financing.
So
this one will.
So
there is no limit on the number of properties that you can have financed.
Strategically, generally, it's better to max out your Fannie Mae, Freddie Macs and then go into DSCR, which is why it's ideal for more experienced investors. I get it.
Yep.
That makes perfect sense.
Yep.
Now, how does it, can you give an example of how it works? Can you give us a scenario?
Sure can. Are you ready? I'm going to make up numbers for my math brain. I don't think that there are very few places in the world right this second that are going with these numbers, but it makes it easy for me to follow along.
That's okay. We like easy math.
They're looking at debt service coverage ratio. Does the rent cover the debt service on this property? That's what it's based on.
Debt service being your PITA.
Mm-hmm. Debt service, yes. How much debt servicing are you doing per month?
Got it.
Yep. Full mortgage payment, principal, interest, taxes, and insurance. So if your rent that you're going to get on this property is $1,000 per month, and your mortgage payment all in is $1,000 per month, you are breaking even. You have a ratio of 1.
Okay.
You're good.
Which we frequently advertise as not a great way to get into investments. Like, unless you're really counting on an equity piece there. We know you always want a bit of income on top of your monthlies.
Hopefully so, but for illustration purposes.
Gotcha.
You got a 1.
Okay.
You're breaking even,
So
you get a 1.
1.
And you could do a DSCR loan. As long as the rent covers the payment, you're good.
I'm going to throw a question out that we didn't talk about before this. Is that based on a 75% of the market median, or do we know?
It's a very good question that I could follow up with an answer to on our next episode to clarify. But if I had to guess, it's going to be 75% of market rent, according to what the appraiser says rent is. So that means you got to be doing pretty good. You can't just get $1,000. You've probably got to get
So the 75% margin, we're fairly certain applies here.
I'll confirm that for certain. And I suspect that there are different rungs where that might apply to. If you put more money down and your loan to value ratio is lower, they might ease up on that.
Okay.
There's a little bit of wiggle room with these loans.
Oh, interesting. Like they're willing to be more flexible with them, probably because they recognize the portfolio that's backing it.
That could be. And if you have reserves, that goes a long way in helping to make some adjustments in these things.
Got it.
So, yeah.
And also, I think by the time you get to a place where you're playing around with these kind of loans, you got some money to throw at them.
You got some backing.
Well.
You've just got a whole portfolio of things that comes to the table. And at this point, they are looking. Now, here's the trick. They are looking at this property. Right? It is, and that's what the loan is based on.
That is what it is based on.
And so the rest of your portfolio really doesn't matter. Your bank account does.
Okay.
If you've got reserves and other things of that nature to help compensate, you might get a little leeway in those areas.
Okay, so just because your income doesn't support it,
you have to document the funds.
You still have to make sure that you've got the funds for it. You still have to have prudent reserves, just like you do for other investment products. And the better your buffer looks, the lower risk you are to the bank, so the more likely they are to lend to you.
Yeah.
So it's just how general loans work, but this one allows you to use rent to cover, to qualify. That's cool,
and to omit, though, to omit the other things that might not be looking so great on paper. If you are self-employed and your business had a down year and you've got negative cash flow one year, in conventional mortgage lending, that negative can't just be overlooked. It's actually factored into and deducted from your overall income calculation. This alleviates that.
And I also think about right now in our industry, where many people like us want to take advantage of the great deals that are coming up with the higher interest rates. It's pushing prices down and it's decreasing competition. So right now it's kind of a great time to buy, but a lot of us aren't making as much money as we were in previous years because recession.
Sure.
And it really affects our industry and our annual incomes. So this is the type of people you're going to see using these are likely going to be people in our industry, as well as other people whose jobs are affected by recession factors.
Yeah. And as long as you have the cash, that's the deal. And so the example that I've given, the person who's doing a 1031 exchange, perfect example. This is really what it's meant for. Let's go back quick and finish up about our cash flow.
Finish our example. We got on a rabbit trail there. So 1-to-1 is a 1 break even.
And it's a win. You can do it.
Okay.
Even better if you're moving up. If your rent is $1,100 and your mortgage payment is $1,000, now you have a 1.1% ratio. That's golden. Every lender's a little bit different. Everybody's in the same small ballpark about what's acceptable and what they will do to lend on these. Everyone is a little different, has their nuances. If you can get to that 1.25% where your rent is 25% more than your mortgage payment, they're going to love you. Okay.
All right. So 1.25 is the magic.
It's optimal.
It's the optimal number. Okay.
It's optimal. It's not required, but it's optimal.
It sounds like a pretty great product.
Under the right circumstances, it sure is.
That being said, what are the I guess perceived downsides to the product? What do we need to know about? Not scotches, because realistically, all of those things have to be disclosed. And if you're not reading your paperwork, that's on you. But
you got yourself.
Yeah, you got yourself if you don't read your disclosures. But what are things that people just need to know to consider?
Things you need to know. Non-conventional mortgages come with more than often than not non-conventional pricing. You're going to pay interest rate and or discount points. Likely right now in this time that we're in right now, you're paying both. Yeah. I did an exercise to price out a conventional 2 to 4 unit investment property purchase versus a DSCR 2 to 4 unit investment property purchase. All things considered, the pricing wasn't all that different between the two. Pricing meaning interest rate and discount points.
Okay.
You are going to pay max interest rate right now, which is squarely in the 8s. Ooh, squarely in the 8s, and you are going to pay points.
That's actually not that bad
It's not that
in the grand scheme of things, but compared to when money was almost free the last couple of years, a lot of people are having a hard time with it. So ignore my dramatic response. 8 is not that bad. So, but you're going to pay high.
You're going to pay whatever the market rate is, and the market rates now are in the 8s for both conventional and DSCR. Yeah. You're also going to pay points plural. You're likely looking at a couple of points in either scenario.
But you can write points off on your taxes too. So which is, I think that's a big thing that you always have to keep in mind when you're looking at investment products is like, oh man, the people get really caught up on the points and the fees and the costs. And it's like, okay, remember you can write a lot of this stuff off and use it to offset your taxable liability, and you get depreciation on the properties. So don't get too hung up on the points.
Yeah, don't get too, it's the long-term plan. Is a couple of extra $1,000 up front. Does that work into the long-term plan of cash flow, equity gain, and what your long-term plan for this property is?
The bottom line is, are you making money?
Mm-hmm. Will you make money?
And is it enough money to cover what you need to cover?
Yeah. So that's the thing. You're going to pay when I priced the difference between the conventional and the DSCR last week or the week before, the DSCR had more in points than the conventional did. So that would have been the downfall. Okay. Nothing really to be terrible about. I mean, they're both 8% loans with some points.
I mean, if it means you couldn't purchase it any other way, then buy the property and, ride it out. That's the whole point of purchasing in a down market. Is part of the reason it's down is because there are factors that other people don't want to take on. Yeah. And that's where you're going to get a good deal.
Yeah. The other thing really that you need to know about, really the only thing to consider and factor in to this price discussion, is prepay penalties.
Talk to me. We haven't actually talked about prepayment penalties, I think, on this show before. So tell the people what that is.
They are things that we did before Sorsha was alive in the world, how mortgages used to come.
There was a lot of them on the adjustable rate loans in the 2008 crash.
Yeah. It kind of used to be a standard thing.
I was also alive in 2008. I just want to put that out there.
You were. I'm being facetious.
I was 13.
Exactly. I was writing mortgages. You were 13. Prepay penalties used to be semi-standard, both in non-conventional world and in conventional world. It just used to be an option. And then Dodd-Frank 2008, a lot of things changed with that, just because people weren't reading their paperwork. But now they maybe didn't have somebody explaining to them thoroughly what was happening, and that sucks. But also you weren't reading your paperwork, and that sucks.
Yep.
So things have changed. Prepay penalties are not a thing on standard conventional mortgages anymore. But in non-QM world, non-qualified mortgages that don't fall under Fannie Mae, Freddie Mac types of things, prepay penalties are pretty common, which means you are obligated to be in this mortgage for a certain period of time. And that could be 1, 3, 5, or 7 years. And if you sell the property or refinance that mortgage within that time period, you're going to pay a penalty.
And so that just means that if you are buying this at 8 and your plan is to refinance, you need to make sure, at least in my opinion, what I would advise a client is you need to make sure it cash flows at 8% in the event that the prepayment penalty exceeds what a decrease in interest rate would motivate you to change your loan with.
Yeah.
So I said that in a really weird way, but the idea being you need to factor that into your costs so that you are correctly estimating your overall cash flow.
Yeah. Prepay penalties aren't huge.
Can you throw out a number example on like a $400,000 loan?
Not even close.
Okay.
A few $1,000s at some point. It's nothing. There's a whole range and scale, and the difference between 1, 3, 5, 7 years. It's really an investor is making a loan to you at pretty
reasonable
terms for a relatively risky-ish loan. You're not documenting anything about your personal income or wherewithal, if this property is vacant, things of this nature. Yeah. So they're making a kind of a risky loan to you. And so this is their way of helping cover themselves to make sure that you're in this loan long enough for it to make sense for them to lend that money.
Yep. And
we're all in it to make money. The bank too. Yep. Don't be mad at them.
It's like if you wouldn't be able to purchase the property without the loan, then you can't really resent the loan terms as long as you're making the money to cover it.
Yeah. So we just need to factor it out. There is the option if you wanted to pay the prepay penalty out up front, you could do that. Okay. So that you had 0. Or just read your paperwork, find out what your information calculate what the prepay penalty is in 1 or 3 years in, because you're likely to refinance then when rates come down at some point in the next few years. And just make sure that makes sense. If you can withstand a few $1,000s in a prepay penalty, then okay.
Yeah. And it's like, and this is based on long-term rental numbers that we've been doing these calculations, but like, there's nothing that says you can't rent it as an Airbnb, right? Or that you can't rent it through other means where you're getting way bigger cash flow numbers. Mm-hmm. So make sure that you just like have a plan in place for how you're going to make the money on this house. And I think like if I were to do this on like an Airbnb property where the long-term rental numbers justified the mortgage price, I would make up that prepayment penalty in like the first year.
Yeah.
So it's just... It's
not a worry, just you need to know.
You just need to be aware. So in conclusion, DSCR loans are a cool product. Mm-hmm. And we're going to probably start seeing more of them being utilized. Ideally, you should think about your strategy in leveraging them versus conventional loans and where your portfolio is at and where your finances are at. But they're a cool tool to use to continue picking up great investment properties even when your personal income is down.
That's right.
Pretty neat.
There we go.
Big
Let's
fan.
do that.
All right. Well, thank you guys for joining us today. If you have any questions about DSCR loans, you can message Shannon by going to the laddercast.com and click Work with Shannon.
You can.
She will actually answer you. She's on the other end of that button. So, well, not literally. It takes you to her website and then you fill out a form and then she's on the other end of the button.
Yeah.
But you can talk to Shannon about it if you're interested in purchasing a property with DSCR here in Portland or Vancouver or Oregon, Washington, or anywhere else in the world. You can reach out to me. And if I am not licensed in that state, I will refer you to someone in your area who's great at what they do.
Yep.
And we really appreciate you coming today and listening to us and would love to hear your thoughts. So drop a comment and give us a like and follow.
Thanks.
Bye.
Bye.